Thank you for tuning in and welcome back, team. In today's episode of Real Estate Investing, you'll learn how to figure a cap rate. My name is Andrew Finney, your real estate geek. If you need help finding a top agent where you live, or if you simply want to drop me a line to say hello, my contact info is below. If you haven't already done so, please go ahead and subscribe to this channel now and like this video. Okay, team, so let's talk about what is a cap rate, especially if you're just new into real estate investing, or even if you've been around for a little while and looking to hone in on your real estate investment skills. Real estate investors, as you know, will use different kinds of data to make a well-informed decision about what income-producing property they wish to purchase. Some examples would include the desirability of the property's current location, any prospective changes in that neighborhood or around that area that may attract a higher price or actually detract from the property's value. Those are two really important things, but when it comes to cap rate, now we're talking about numbers. And cap rate is actually a capitalization rate. So even though we're saying the word cap a lot, it's short for capitalization rate. So when you're talking with trusted real estate advisors and other real estate investors, you're going to hear this term a lot. So it's important to know what it is. And one of the best ways to express what a cap rate is actually the ratio of the property's net income to its purchase price. And knowing what the ratio of the property's net income to its purchase price is will allow you as an investor to compare properties by evaluating the rate of return on the investment made in the property. So if you're considering an investment property, then you may want to calculate the cap rate or capitalization rate, if you will, into your decision and factoring how much money that property is going to earn for you on an annual basis in the form of your rents. So let's talk about how you calculate a cap rate. By calculating the cap rate, what we're going to look at is the annual gross income of your investment property. The gross income is a piece of the investment property, will mainly be in terms of like rent rolls or just your rental income that you're going to be getting. So in short, a real estate investor buys a home. Usually you make money from it primarily by renting it out to tenants. And however, it's not the sole possible source of income. Miscellaneous income can also accrue from the property from coin-operated vending or washing machines if that's something you're providing. And also you're going to have the home equity at large. But for the purpose of this video and for the purpose of discussing cap rates, let's stick to the point of going off of the annual gross income. So let's say that you have a property and that property earns $1,000 a month in gross income. If we multiply $1,000 a month by 12 months in a year, that means your property is earning $12,000 a year in gross income. So for the second step, what we want to take a look at is subtracting the operating expenses associated with the property from the gross income itself. So we also need to account for things like a vacancy rate. If you have a multiplex or a fourplex, threeplex, duplex, whatever, you're going to also want to consider what your vacancy rate may be. A great source of income or a great source of information for that is actually your trusted real estate advisor. So now let's take a look. Let's break down what some of your costs would be in owning a rental property. So let's say that you rent out your property for $1,000 and you can expect to get $1,000 every single month for your rent. And we're going to base this off of a 12-month average, okay? So let's say that you're using property management, and property management is charging you 10% of the gross rent every month. Over the course of a year, that would equal $1,200. Let's say that you budget $600 a year for annual maintenance that needs to happen with that property. And let's say that you have about $800 a year in property taxes. And you pay roughly $750 or so in homeowners insurance per year. So then if we're taking a look at these numbers, the next thing that we're going to take a look at is aligning those numbers out. So let's take our total sum number of annual gross income from your investment property of $12,000, subtract the $1,200 in property management, subtract the $600 in home maintenance, subtract the $800 in property taxes, and subtract the $750 in annual insurance. After you deduct those numbers, it equals $8,650. So the factor to get your actual cap rate on your investment, now let's say that the third step here is to actually divide the net income by the property's purchase price. Now the purchase price is one thing we haven't discussed yet for simplicity of this video. Let's assume that you paid $100,000 for this property, okay? So with $100,000 that we paid for this property, after we made our deductions in step 2, what we want to do is take that figure, $8,650, divide it by $100,000 for your purchase price, would equal 0.0865, which expressed as a decimal would be 8.65% would be your capitalization rate, which is actually a really good rate of return. Anything above 6% would be awesome. So now let's talk about how you can use this information wisely when you're out and comparing properties. To use cap rates quickly, compare similar investment properties. Compare them to location, compare them to relative size, and consider what you're going to be doing. So take, for example, that if you were going to be considering buying two pieces of property in the same neighborhood, one had a cap rate of, let's say, 8%, and the other had a cap rate of, let's say, 14%. The initial comparison would favor the second property, wouldn't it? But not so fast. There's still some things that you should consider, because what if you're looking at step number 2 in learning how to use a cap rate wisely, and the cap rate isn't the sole determining factor of the investment's health? Take, for instance, when we're talking about the property value. The market increases what's happening to your property's value. As the market appreciates, you're actually gaining what's called home equity in that investment property. Consider like your rental income essentially dividends that are being paid on a larger investment. That larger investment's rate of return is really accruing through the home equity that you gain over time through home appreciation. So if you take, for example, the first piece of property, and let's say that you paid $1 million for it, and you were going to earn $100,000 per year, that would be a cap rate of 10%, right? Now let's say the property value suddenly increased by the end of the year to $1.5 million. Well, then you'd have a much less lucrative cap rate of something around 6.66 to 6.67% as a cap rate. Well, then you're thinking, well, it was 10% at $1 million, but now you've also picked up $500,000 in appreciation, which actually dropped your cap rate. Those are the things that you want to be considering and looking at the market appreciation, at least ways as much as all of us could ever wish to have a crystal ball. But if we look at the past appreciation and we watch the indicators in the market, we may be able to formulate a good idea of what the market appreciation may look like in the future around your investment property. In doing so, you'll be able to better plan how much home equity you can boost by, and about how much you will be able to expect on a annual rate of return by factoring in the capitalization rate. So step 3 in learning how to use cap rates wisely is actually using the cap rate to justify the income level of the investment property. So you want to take into consideration, let's say if you bought a property for, let's say, $400,000 in an area where most similar properties have about an average of an 8% cap rate, then you might find or be recommended an income level by multiplying 400,000 times 0.08 would equal $32,000 a year, and that'd give you an idea of the actual representation of the amount of net income you could expect for that income producing property to generate every single year for you at an 8% cap rate. Keep in mind that you cannot set rental rates based upon the cap rate alone, but it'll be a good benchmark, at least for an idea of what the ideal target would be. You know, if you're saying I want a 10% cap rate, but the rental market doesn't justify the rental income that you wish to derive from that property, then you're going to have to balance it with the market. A great source of information for you when it comes to knowing what rental comps are looking like is working with a trusted real estate advisor in your local area. Again, if you don't have a trusted real estate advisor and would like me to put you in touch with a top agent that can help you out, please let me know. I'll put my contact information up right now, even if you just want to drop me a line to say hello, or you have another great idea for another real estate investing series, whether it be with cap rate, flipping property, renting property, or investing in other methods of real estate through stock market exchange or something like that. Let me know what you want to see in the comment section below, and feel free to send me an email. I always enjoy hearing from you. Now, what I'm going to ask you to do now is tell me what you got from this video. What was the most impactful part of this capitalization rate video? Was it actually learning what a cap rate is? Was it learning how to calculate a cap rate? Or some of the things that you might want to consider when learning how to use a cap rate wisely? Tell us what you learned from this video in the comment section below. If you haven't already done so, please go ahead and subscribe to this channel now, like this video, and share it around with someone you know is going to be able to help. Thank you so much for watching today, team. In between now and next time, I'm wishing you and yours a lifetime full of love, wealth, abundance, and happiness. Thank you.